Wonderful. Well, we thank everyone so much for joining. Matt, we're excited to have you today. We're just going to give people a minute or two here to get in, and then Tony will kick us off with a few introductory words, and we'll pass it over to Matt for today's presentation.
We'll go one more minute, Nelson. We got way too much good content to be waiting, so people can catch up if they join a little bit late. 103 kickoff.
I love it. I love
Okay.
it. And it does look like everyone from the waiting room has now entered the meeting. So
Okay.
we might have a few stragglers, but I will continue to watch it and monitor it. But I think we're good to go.
All right, very good. Hey, a warm welcome to all of you. My name is Tony Parr with the Parr McKnight Wealth Management Group, and I just want to start out with a candid confession. I've been in this business for just under 40 years, and I never, ever thought that Parr McKnight would host a cryptocurrency webinar for our valued clients and their hard-earned wealth. But here we are. So I just thought I'd take a moment and share with you a little bit about my cryptocurrency journey. I guess number one, I would have called myself an atheist. I didn't believe cryptocurrency was not a currency. You couldn't buy a Frappuccino at Starbucks with crypto. I thought it was a scam. I thought it was going to zero. I thought it was a lesson for young people to teach them humility so they'd lose all their money and then come back and just simply buy Walmart and Procter and Gamble and Microsoft. So I started out as an atheist. And then I guess I became an agnostic. I said to myself, well, after some research, this could be a thing. And I saw more and more notable people in the investment world buying into it. And I saw some notable people flip-flopping. They said it wasn't a thing. And then they were all of a sudden announcing their hedge fund holdings and they were into crypto. But at that point, I certainly didn't need it, wasn't going to recommend it to clients. And then after some more research, some more smart minds on Wall Street started tipping over, and I saw our speaker, Matt Hougan, I became a cautious believer. And our speaker is going to share with you the conditions on the ground with crypto have changed. And I really believe in something that my partner, John Rudy, says all the time. He says, listen to Warren Buffett's right-hand guy. Charlie Munger counsels us to hold on to our convictions loosely, allow more information to come in, use your sense of perspective and discernment to continue making progress with your thought process. So here we are. I've made two investments in Bitcoin, and each of them were at the Barron's Top Advisor Conference virtually immediately after I was done listening to Matt Hougan deliver the keynote address. Another thing to note is our firm, Parr McKnight, we have not bought crypto for any clients on a discretionary basis. Now, those clients that own it through us, they called us. They asked us, what do you think? We said, I don't know. And they bought it anyway. So we have yet to make a discretionary purchase in cryptocurrency. And discretionary means our clients have given us authority of the day-to-day management in their portfolios, and we have not done it. So we'll see what happens after today. I should let you know we are prepared to deploy crypto into our client accounts, but I must say we need to have a good financial plan in place. We need to understand your balance sheet, your cash flows, your long-term goals, and make sure we have a conversation about the anticipated behavior of crypto, which we're going to hear a lot more from Matt Hougan on. But before I bring him on, I want us to tee up a little survey. Matt did this at the Barron's conference, and I thought it was a great way to get you all involved. So take a peek. Question number one is, do you currently own any cryptocurrency? Just grab your mouse and answer this if you would. Yes, a significant amount. Yes, a small amount. No, but I'm considering it. No, and I'm not interested. So let's give people a couple seconds here. I see a blue bar, no, but I'm considering it. That's about 50% of our audience. Give it another couple seconds here. I think we're leveling out right here. I love the folks that said no, and I'm not interested, but you're curious enough to be here with us today. Yes, a significant amount. I want to know who those three people are. Nelson, do we have the capability to do that? No,
We'll
we
have to do
won't.
some forensic analysis after the call.
Despite the technology, we're going to let people remain anonymous here. Well, good. Nelson, do we have another question teed up?
Just for the end of the
Just for the
um,
end. Okay, let's go on. So I want to bring you Matt Hougan, and I want to bring you Matt commercial free. So there's only one commercial you're going to hear. I love talking about our team. Nelson, would you tee up the picture? Maybe we can do that for just a minute or two. So Parr McKnight is a fully independent registered investment advisory and planning team. Last fall, we went fully independent, separated from Wells Fargo. They maintain custody of our client assets. There's 15 people on the team. This is our work family. A full 7 people, roughly half of the team, are certified financial planners. And we have one JD. Kelly's got a law degree, having been involved in taxes and estate planning in her previous career. We are a true ensemble team. Often, when you see teams of this size, each advisor has their own clients, and people don't talk a lot. They have the illusion of a team, but they really work one on one with clients. We were just on an hour-and-a-half meeting this morning, all the advisors talking about a number of clients, the issues that they're having, and bringing our collective wisdom to provide solutions to clients. We are a multi-generational team of advisors. You will find advisors on Parr McKnight that are in their 20s, in their 30s, in their 40s, in their 50s, and if I round up just a little bit, we can say in their 60s also. I'm 59, about to turn the corner into 60. And it's so refreshing for me to be a part of those conversations because everybody brings their research, their life experience, their experience with the clients that they're point person on, to bring great results to all clients. So it's just a wonderful team to be a part of. We have about $1 billion of other people's money, which we take very, very seriously. We feel like that's been entrusted to our care, and we just need to be careful stewards of those assets. The advisors on the team collectively have about 130 years of experience. And the thing I'm most proud of is we have no lawsuits, no arbitrations, and it's in our DNA to avoid ethical lapses with clients. So it's a record that we're very proud of. All right, after the ad here, on to the main event. I want to introduce Matt Hougan, and he's got such an extensive bio, I had to truncate it a little bit, but I'm going to read this to you. Matt Hougan is Chief Investment Officer of Bitwise Asset Management. He's a leading authority on cryptocurrency, exchange-traded funds, and financial technology. As the Chief Investment Officer at Bitwise Asset Management, which is the largest provider of cryptocurrency index funds, he oversees the firm's investment strategies and research initiatives. My bio said Matt and Bitwise have about $1.5 billion under management. I think he's going to revise that figure upward. Matt is also an accomplished author. Matt co-wrote 2 white papers for the Chartered Financial Analyst Institute Research Foundation. One was on exchange funds, and the other one, listen to the title, Crypto Assets, the Guide to Bitcoin, Blockchain, and Cryptocurrencies for Professional Investors. Matt's insights are frequently featured in major media outlets including Barron's, Bloomberg, the Wall Street Journal, and CNBC, and he's also a crypto columnist for Forbes. He's been a 3-time member of the Barron's ETF Roundtable, and I'm just dying to ask him how his BA in philosophy from Bowdoin University has complemented his career. I was going to engage in a Q&A session with Matt to kind of drive the presentation, but my wife tells me quite often it's not about me. It's about you getting the same high-level content that a few of us at Parr McKnight received at the Barron's Top Advisor Conference when he delivered both keynote addresses for last year and the previous year. So I'm not going to get in the way of his flow. I'm just going to turn it over to Matt. So Matt, take it away. Light us up on crypto today. We're all really curious. Thanks for being with
Um,
us.
Oh man, Tony, what an intro and what an invitation to this incredible firm. Really admire what you've built and the service that you provide for clients. And to everyone tuning in, thank you for taking an hour out of your busy day to learn about crypto. I'm going to share my slides. This is the hardest part of my presentation, so if you can just bear with me for 1 second. Um, the goal today is to provide some balanced thoughts on what crypto really is. Crypto is one of those highly controversial areas of the market where, depending on who you talk to, it's either the best thing since sliced bread or a confusing, threatening item. And what we try to do at Bitwise, as Tony mentioned, is provide balanced education about what this really is. As Tony mentioned, I'm the CIO of Bitwise. Bitwise is a specialist crypto asset manager. One unique thing about us is we've been in this market since 2017. So I've lived through multiple bull and bear markets of crypto. We've been stewarding investor capital since then. Tony's right that our assets have gone up significantly as crypto's gone more mainstream. We're now north of $10 billion of client assets and growing. And we're a team of 100 plus professionals in the US and Europe serving the best financial advisors and family offices and institutions in the world. The agenda today is really pretty simple. Here's our incredible executive team, strong backgrounds from whether that's the government or Facebook or firms like Goldman Sachs or myself from ETF.com. The agenda really is simple today, which is just two things. I want to give you an update on where crypto is in a section I call the Great De-risking, because the journey that Tony described from a skeptic to agnostic to cautious believer is a journey that I think many people are on, right? Whether you're an individual investor or some of the largest institutions in the world have been on that journey. And the first section of my presentation today is going to talk about why that's a valid place to be. How many of the biggest risks in crypto, not all of them, but many of them have been removed over the recent years. And then after we review the risks and how crypto functions today, I want to talk about the opportunity. What is it that crypto and specifically Bitcoin is building, and how big could that be in the future? And then we'll jump into Q&A. But I thought I would start with this. I know one of the challenges when you talk about crypto is that no matter who you are, to some degree, you missed it, right? Crypto is the best performing asset in the world. It's up 95 million% over the last 15 years. It's outperformed most other assets over other major periods. Since I've been at Bitwise, Bitcoin is up, more than 1,200%. And so I thought I'd start with a sad story about myself to make you feel better, which is, the first time I really encountered crypto was back in 2011 when I was running a company called ETF.com, which was the leading data and analytics provider in the ETF space. And I had a team of young analysts. And those young analysts were very smart, traditional financial analysts, credentialed with the CFA Institute credential. And every week, one of them led a conversation on a topic in the market. And in February of 2011, the analyst who led the conversation talked about Bitcoin. He talked about Bitcoin because that was the first time that Bitcoin passed $1. And it was called, the dollar match day or the dollar equivalence day. And he gave an hour-long presentation about Bitcoin when it crossed $1. And if I had left that presentation and went and bought 1,000 Bitcoin, it would be worth something like $92 million today. And instead, I went and got a cup of coffee. And I tell that story because everyone has been in that place. The first time we heard about Bitcoin was much earlier than its journey that it is today when it's trading for $97,000 per Bitcoin. But I want to give you some confidence that the decision to sort of look skeptically upon it in its early days was all valid. I think there were many people, there's some people out there who wish they had bought Bitcoin when it was trading for a penny. When it first came to market, it was trading for a penny. Imagine if you had put $100 to work investing in Bitcoin when it was just a penny. You'd be extraordinarily wealthy today. But the reality is, at the time, Bitcoin was extraordinarily fragile. At the time, the entire Bitcoin network was being run on one computer by a person who we don't even know, right? And if that person lost interest, or that person went to lunch, or they didn't pay their internet bill, all of Bitcoin could collapse. And importantly, a little fact that many people don't know, Bitcoin wasn't the first attempt to create this version of a decentralized gold or a cash-to-cash internet settlement effort. There had been about 30 different major efforts going back, dozens of years. I'm showing here an article from the American University Law Review that was written by the NSA, the Government Intelligence Agency of the Department of Defense, called How to Make a Mint, the Cryptography of Anonymous Electronic Cash. That almost sounds exactly like Bitcoin. And the government was trying to do this in 1997, but no one actually made it work until 2008. And it was, of course, this person, who we don't know who they are, Satoshi Nakamoto, who came up with the code that made Bitcoin work. My point in telling this is it's nice to look back and imagine, buying Bitcoin when it was worth just a penny, but there was huge risks that it would even function at that time. There is no reason to believe that this 30th attempt to create this asset was going to be the one that worked. And I say that, some people say, well, what about when it was $1? At that point, it had been functioning for a couple of years. You had analysts talking to you, Matt, about Bitcoin. But I have to give myself a break, because if I had wanted to put $1,000 to work at Bitcoin at the time, the largest place to do that at the time was a firm called New Liberty Standard. And I use the word firm with quotes around it because this was just one guy running a website. And here's what his website said. You can buy Bitcoins by sending a PayPal payment to newlibertystandard@gmail.com. I try to process all these orders in 48 hours. This is a personal hobby, and everything on this site is legal as far as I know. I raise this because I don't kick myself for not buying Bitcoin when it was $1. There wasn't a ETF. There wasn't a institutional way to do it. You were literally sending money to a random email address and hoping that it was legal. So I'm a chief investment officer. I consider myself a reasonable investor. I'm going to let myself off the hook at $1. So what about when it was $10? This was a few years later. What about when you wanted to allocate when it was $10? Well, the reality at the time was that there was extensive criminal activity on the Bitcoin network. I'm going to explain it a little bit, that criminal activity has nearly entirely disappeared, and tell you why it has disappeared. But back in 2013 and 2012, when Bitcoin was trading for $10, you were taking on a lot of reputational and legal risk, potentially by interacting with this new asset. What about when it was trading for $100? At this point, it had been around for a while. They had clamped down on some of that criminal activity. Well, at the time, the largest place to custody your assets was a firm called Mt. Gox. And Mt. Gox wasn't an institutional custodian. It was actually originally a place for trading Magic the Gathering cards. That's where Mt. Gox comes from, the name. And they ended up losing investors' money and going bankrupt. So it wasn't available for institutional investment. I can keep going through this. When it got to be $1,000 in late 2013, there were news stories about it. It was on CNBC. There were Wall Street Journal articles about it, but it wasn't a serious industry. There were no institutional players. This is a photo from a crypto conference at the time. These people are not building the world's next version of gold. They're doing this with their fingers. I don't even know. It was hard to attend these and imagine you were seeing an asset that would be one day owned by 9 of the 10 largest hedge funds in the world, or one day owned by governments and corporations everywhere. You could fast forward a little bit longer to $10,000. At this point, firms like Bitwise were in the market offering institutional exposure to Bitcoin. But at the time, there were still very significant risks. This is Gary Gensler, who is the former chairman of the SEC up until about 8 months ago. He did not look favorably upon the crypto market. He launched major lawsuits against crypto. There were huge regulatory risks in the ecosystem, and you weren't certain that this would persist in a fundamental format going forward. And I would argue you could even advance to January of 2024, when Bitcoin was trading for $50,000. and the first exchange traded funds launched that provided exposure to Bitcoin. Before those ETFs launched, it was challenging to get exposure to Bitcoin, and it was outside of the mainstream. There weren't large financial institutions allowing you to access this space. But once we had ETFs, a lot of that regulatory uncertainty was gone, and you now had an easy way to gain exposure. But I would say even then, there was still a major risk. People used to ask me about this all the time. They would point out that in 1933, the US government seized people's gold because they didn't want US citizens holding gold on their own. They wanted to bring it into the government coffers. We were on a gold standard at the time, and they made it illegal for private citizens to own gold. People used to ask me, will the US government really allow Bitcoin to become an institutional, globally accepted new form of currency? Or is it just going to seize that Bitcoin? And to be honest, a year or two ago, I didn't have a good answer to that. But I want to give you a view on where Bitcoin is today and why I think many of those risks have been completely removed for the market. So I want you to update your priors on what Bitcoin is today, and let's look at it from a risk return perspective in today's market. I would start with this. This is a chart of Bitcoin's uptime as a financial network over the last 15 years. It has had 100% uptime over the last 10 years and 99.989% uptime over the last 15 years. This is truly remarkable. The largest financial institutions in the world cannot match this, right? Stocks only trade 6.5 hours a day, as an example. But even banks have had substantial periods of downtime. Even SWIFT, which is the US maintained global financial network for how dollars move around the world, shut down a few years ago. Bitcoin has been the most reliable financial network in the world for the last 10 years because it's decentralized, it's globally available, and it's simply performed perfectly. What about that risk that I talked about at the beginning of Bitcoin being created by one person and maintained on one computer? And what if that one person lost interest? Well, this is a chart of the amount of computing power that's focused on maintaining the Bitcoin network versus the computing power of the top 500 supercomputers in the world. And what this shows is actually the Bitcoin network is, by a factor of more than 1,000, the largest supercomputing network in the world. There are now hundreds of thousands of massively powerful computers, all focused on maintaining this network, which have been supporting it and giving it that 100% uptime over the last 10 years. So I think that infrastructure risk has been substantially removed. What about the custody risk? I mentioned earlier that in the early days of crypto, you were custodying at firms like Mt. Gox, which were companies that no one had heard of and that weren't well regarded in the space. Well, today, when we custody crypto assets at Bitwise, we work with firms like Coinbase, which is a $80+ billion publicly traded company, or firms like Fidelity, one of the best brands and best known names in crypto. And in the next year or so, we expect the Bank of New York Mellon, which is actually the oldest financial institution in the US. It traces its roots back to the 1700s, and Alexander Hamilton. We expect them to be able to custody crypto. So we've come a long way. They're now institutional custody solutions. I would add on the trading front as well, we've come an enormous way. I mentioned when Bitcoin crossed $1, if I wanted to buy Bitcoin, I was sending an email to a random PayPal address. Now, when Bitwise goes into the market, and on any given day, we might buy or sell 50 or $100 million of Bitcoin, we're interacting with firms like Jane Street and Citadel. And if these aren't brand names that you recognize, these are the largest companies that trade stocks, bonds, and derivatives in the world. The same people and same firms that are handling most of the world's stock, bond, and derivative volume are today handling much of the world's crypto volume. It's become an incredibly institutional asset. What about mainstream institutions? This is a fun chart that looks at what the largest financial institutions in the world are doing in crypto. And whether it's Bank of America or BlackRock or the CME or Deutsche Bank or Fidelity or Goldman Sachs or the London Stock Exchange or MasterCard or Visa or Wells Fargo, the reality is that every major financial institution on Wall Street now has dozens or hundreds of people focused on this market. I know that may sound surprising to many people because we think of it as this decentralized, retail-driven market happening at the edges. But I can tell you there is insatiable demand on Wall Street to build into this market because they see it as the future of how much of finance will work. What about that criminal activity that I mentioned? Well, it is true that there was substantial amounts of illicit activity in Bitcoin in its earliest days. But I'm showing this chart. This is from the data provider that the US government relies on to analyze illicit activity in the crypto space. And you see that there is a dramatic fall off in the share of transaction volume tied to illicit activity after 2019. There's a very good reason for that, which is that 2019 is the year that the 20 largest countries in the world started applying something called the travel rule, which required all crypto exchanges to know who their customers were. Before 2019, they didn't have to apply what are called anti-money laundering laws, or AML, or know your customer requirements, KYC, when they were bringing people onto their platforms. But starting in 2019, they did, and you can see that the share of illicit activity fell substantially. At this point, the share of illicit activity on Bitcoin is much lower than the share of illicit activity in cash and traditional US dollar payments. And the Department of Justice has come out and actually acknowledged that Bitcoin is not used in any major way for illicit activity today. What I mentioned earlier, one of the risks in the early days of crypto was, would institutional investors buy? Well, this is a chart that looks at the amount of assets held by spot Bitcoin ETFs. Spot Bitcoin ETFs came to market in January 2024, and they're the primary way that institutions are accessing Bitcoin today. And you can see that the assets have grown from about 25 billion to over $100 billion. In my previous life, I was the CEO of ETF.com. So ETFs are a space that I know and love dearly. Tony mentioned I wrote the CFA Institute's Guide to ETFs back in 2015. This is the fastest growing set of ETFs of all time. There have been 6,000 plus ETFs launched. There's $7 trillion of assets in ETFs. And Bitcoin ETFs had seen more adoption than any other asset category. And it's firms you know. This is Stan Druckenmiller. He's widely regarded as the leading hedge fund investor of our generation, and he owns Bitcoin. This is Ray Dalio. He founded Bridgewater Associates, which is the largest hedge fund in the US. He owns Bitcoin because he's concerned about the outlook for the dollar. This is Larry Fink, the CEO of BlackRock, the largest asset manager in the world. He owns Bitcoin, and his firm owns over $50 billion of this asset. And it's not just individuals. The Texas retirement system, the pension fund there has an allocation to Bitcoin. Wisconsin's pension fund has an allocation to Bitcoin. We now have the US president speaking at Bitcoin conferences. We have a bill in Congress that would require the US to buy 200,000 Bitcoin per year for the foreseeable future. We've seen huge amounts of regulatory progress with the SEC putting in place firmer regulations for crypto and peeling back unnecessary lawsuits. We have countries around the world that are now allocating to Bitcoin. This was an example of Abu Dhabi, who bought $500 million of Bitcoin ETFs in Q4 of last year. And even here at home in the US, we now have a strategic Bitcoin reserve and a national digital asset stockpile. And actually, the US government owns about $42 of Bitcoin on behalf of every citizen in America. I raise all this to say that the Bitcoin of today and the crypto market of today is not the crypto market of 2012 or 2015 or 2017 or even 2022. This is now an asset that's widely held by institutions, that sits on a firmer regulatory footprint, and that is getting increasing amounts of institutional adoption. That doesn't mean there's no risk. It's a very volatile asset. Its future is uncertain, but it does mean that we now have removed some of the access risks and custody risks and regulatory risks and reputational risks that have previously kept people out of the market. All right, enough about that side of the equation. Tony, now I want to talk about the opportunity. I like to start with this quote. This is what Warren Buffett said about Bitcoin. Bitcoin is rat poison squared. I joked at the Barron's conference that if you want to know what your father emails you when you join a crypto startup, it looks something like this. But it's worth noting why Warren Buffett said this. Warren Buffett also famously didn't like gold, which has recently been at all-time highs, and he didn't like tech stocks early in their journey. And the reason is that he doesn't like assets with no cash flow. And we have to admit that Bitcoin doesn't create cash flow, right? Companies earn profits and distribute dividends, and that's why people value them. Bitcoin doesn't earn profits or distribute dividends, and as a result, people like Warren Buffett don't love it. But I love comparing Warren Buffett to another major thought leader, me, which is, this is how I think of Bitcoin, which is that Bitcoin provides a service. If you think about what Bitcoin really is, it's offering the ability to store wealth in a digital format without relying on a bank or government. Again, I'll say that again because I think it's really important. What Bitcoin does is it offers you the ability to store wealth in a digital format without relying on a bank or a government. And it's the first time you've ever been able to do this. The reason I like positioning Bitcoin as a service is it breaks down this problem with cash flow. We're all familiar with, let's say, software service businesses like Microsoft, right? Microsoft sells software that lets you do word processing and Excel documents and Teams. And if more people want that service, the value of Microsoft stock goes up. And if fewer people want that service, the value of Microsoft stock goes down. Bitcoin is the same thing. Bitcoin provides this service, the ability to store wealth in a digital format without a bank or a government. If more people want that service, the value goes up. If fewer people want that service, the value goes down. The difference is that with Microsoft, you can pay a subscription fee to get access to its software. You can give Microsoft $99 a year, and that's why it goes up in value as the demand goes up. With Bitcoin, there is no Bitcoin company. Bitcoin is maintained by a distributed network of 100,000 plus computers all around the world in dozens of countries. You can't pay a fee to access this service. The only way you can access this service is by buying Bitcoin. But beyond that, the same rules apply. Again, if more people want the service, the value goes up. If fewer people want the service, the value goes down. I think thinking of Bitcoin as a service really breaks this issue that Warren Buffett raises. I've given this presentation a few times. So usually when I do, I know people ask me this: how can you talk about storing wealth in Bitcoin, Matt? How can something this volatile be a store of wealth? Look at these pullbacks. You see Bitcoin, you see this asset down 65%, 44%, 31%, 32%. How can something this volatile be a store of value? The secret to this slide, though, and the reason I'm sharing it, is it's not actually a slide of Bitcoin. It's a slide of gold from when the US went off the gold standard in around 1970 until today. We have this mythical view of gold, which is that it's this steady eddy that always and forever is holding its perfect value. And I think one of the reasons people are skeptical of Bitcoin, which I believe is a digital version of gold, is that they're comparing it to this mythical imagination. The reality is gold itself, while less volatile than Bitcoin, is volatile on short periods of time. The reason we love gold is that it's held its value well over longer periods of time. And actually, if you look at Bitcoin, it's done that well too. Since the start of COVID, the US dollar has lost about 25% of its value, and Bitcoin is up about 30x. So it's actually done an exceptional job. And I think reminding yourself that maybe gold is a little more volatile than you think helps put Bitcoin in context. I actually personally am of the view, I know many people will be skeptical, that Bitcoin is better than gold in many ways. They're very similar in that they have limited supply. They're fungible and decentralized. You don't need to rely on a government to hold a gold bar. You don't need to rely on a government to hold Bitcoin. Gold has been around longer than Bitcoin, for sure, 5,000 years versus 15 years. But Bitcoin is better than gold in many ways. It's never been counterfeited. It's very cheap to store. It's very portable. My Bitcoin ETF has about $4 billion of it in it. If it were gold, it would weigh tens of thousands of pounds, and I'd have to fly it around on an airplane. With Bitcoin, it weighs nothing, which is one of the reasons our Bitcoin ETF is half as expensive as the price of a gold ETF. It's cheaper to store and easier to scale. You can also divide it infinitely because it's digital, and you can transfer it, move it around the world at the speed of light. My own view is that Bitcoin will one day challenge gold as the world's primary store of value, which is how we think about its valuation. I went to the start talking about Bitcoin as a service. How valuable could that service be? Well, today the gold market is about a $25 trillion market. If you took all the gold in the world and multiplied by the price per ounce, you get about $24.5 trillion. From there, you can come up with your own valuation estimate of Bitcoin. We know there are 19.8 million Bitcoin today. If you think Bitcoin will be about half the size of gold at some point, let's say in the next handful of years, the next 10 years, then every Bitcoin would be worth $617,000. That doesn't guarantee that it will be worth that, but this is a framework that you can use and ask yourself, in this increasingly digital age, how big do you think Bitcoin will be compared to gold, given the rising institutional adoption of Bitcoin? And you can use that to back into your own price target. I did want to sort of drive toward the end by providing you with my super secret key to how to value Bitcoin. There's been thousands of pages and many different attempts to value Bitcoin, some of which are extremely complex. I wrote about them in that CFA guide, but I'm actually a pretty simple guy. You know, Tony, maybe it's my philosophy background, but I like to boil things down. And to me, the secret to valuing Bitcoin is actually just supply and demand. Warren Buffett said it, Bitcoin has no cash flow. The price of Bitcoin depends on its supply and demand. And I would submit that this part of the presentation is what gives me a great deal of confidence about where Bitcoin is going over the next 12 to 24 months. So let's talk about those two, because it doesn't have to be a mystery to everyone. Supply is actually really simple. Bitcoin's supply is programmatically driven. It's built into the software. We started with 0 Bitcoin. Eventually, there can only be 21 million Bitcoin. And every 4 years, the amount of Bitcoin we produce as we journey from 0 to 21 million falls in half. So in April of 2024, we had the most recent halving. If you've heard that term, that refers to the fact that the amount of new Bitcoin we produce falls in half every 4 years. And so we know right now that this year, the Bitcoin network will produce 164,250 Bitcoin. That's it. Doesn't matter if the Bitcoin price is up or down. Doesn't matter how many people are mining it. We know programmatically, I can tell you today with near perfect confidence that the Bitcoin network will produce 164,250 Bitcoin. And I'd ask you to keep that number in mind, 164,000, because we're going to compare it to what we know about the demand. So let's talk about demand. There are 3 big sources of demand in the market right now. The first is ETFs. ETFs have made it easy for institutional investors to buy Bitcoin, and they are doing it in very large size. I showed this chart earlier today. Assets in Bitcoin listed ETPs have gone from 25 billion to north of $100 billion this year. And last year, Bitcoin ETFs purchased, I guess this is over 12 months, 572,939 Bitcoin. Now remember, I just told you that the Bitcoin network is producing 164,250 Bitcoin. And ETFs alone are buying something like 3.5 times that. So as we can start to see, there is way more structural demand than there is supply in this market. Now you might ask, do you think that will continue? I do think that will continue. This chart is a chart of the closest comparable to the launch of Bitcoin ETFs, which was the launch of gold ETFs in 2004. I remember the launch of gold ETFs. It was a huge deal. They were the fastest growing ETFs of all time. Finally, we can buy gold in a brokerage account. About $3 billion flowed into ETFs, gold ETFs, their first year, and that was nearly a record. But what this chart shows is the amount of money going into gold ETFs actually built year over year for 8 straight years. Then it took a few years off, and the highest inflow level was actually 16 years after the launch. I share this because everything I look at tells me that the flows we saw last year, where ETFs bought 572,000 Bitcoin, are going to be eclipsed this year and probably eclipse the next year and the year after that. ETF flows tend to build over time because people become more comfortable with the ETFs. People who bought it initially tend to double down. Many large financial services platforms and broker dealers like Wells Fargo and UBS and Merrill Lynch and Morgan Stanley require year-long or multi-year track records. And as ETFs sort of build volume, they tend to get more volume over time. So I think we're going to see more than the flows we saw last year this year. In fact, our prediction is we'll get to about $50 billion in flows this year. We'll see if we're right. But ETFs are just one part of the demand. Another major trend that's happening right now is publicly traded companies are buying Bitcoin on their balance sheet. Some of these are crypto companies like Bitcoin miners or MicroStrategy, which is now called Strategy. But some of them are general companies like Tesla and Block and Semler Scientific. All told, those companies owned 656,000 Bitcoin. And even if you exclude the largest MicroStrategy, which owns 500,000, they own well north of 157,000 Bitcoin. These companies bought 320,000 Bitcoin in 2024. I don't have the data on this slide, but so far this year, they've bought an additional 150,000 Bitcoin just in the first 4 months alone. As a reminder, the Bitcoin network is producing 164,000 Bitcoin, and you have companies buying twice that much. The third source of demand, and then we'll move into Q&A, is governments. There are 10 plus governments that own Bitcoin today. As mentioned here in the US, we own about 200,000 Bitcoin. El Salvador owns Bitcoin. Bhutan owns Bitcoin. Ukraine owns Bitcoin. The UK owns Bitcoin. Bitwise is consulting with multiple governments that are looking at adding Bitcoin to their balance sheet. And indeed, the Trump White House has said its plans to acquire more Bitcoin in a budget neutral manner in the coming months. There are also nearly every state currently is investigating a law to add Bitcoin to their own treasury exposure. And there's a race to see who will be the first to do it. And we're seeing more and more governments every day. Here's some examples of the Czech Central Bank, Brazil, Japan. Virtually every country seems to have some level of initiative to buy Bitcoin or at least consider it as a reserve asset. I bring all those together to give you this chart, which is the price of Bitcoin is set by supply and demand. And we know the supply is 164,250 Bitcoin. Based on what we saw last year and what I anticipate this year, I think ETPs could buy 500,000 Bitcoin, corporations 350,000, and governments anywhere from 0, if they don't follow through, to millions of Bitcoin. It doesn't take a math genius, and I'm a philosophy major, to know that those items on the right add up to more than those items on the left. For what it's worth, and I think this is my closing slide, I'll leave you with this, which is a look at how Bitcoin has traded since the ETFs came into the market, and we had this supply-demand mismatch. ETFs launched in January 2024, and what you can see on this chart is as soon as they launched, the price ran up to about 70,000. You might ask, why did it stop at 70,000? Well, 70,000 was the previous all-time high for Bitcoin, and humans are humans. So there were some people out there who had Bitcoin and were willing to sell at the previous all-time high. You can see where that right line peters out, that once Bitcoin got above 70,000, it raced all the way to 100,000. And you might wonder, why did it stop at 100,000? I would submit that humans are humans. And there's more demand than there is supply, which means existing holders have to sell. And I think the reason it stopped at 100,000 is there were people willing to sell at that level because it's a nice round number. It's currently around 95, 97,000 today. What I would sort of ask you is if we continue to see more demand from ETFs, more demand from companies, and more demand from governments than there is new supply, what happens if and when we exhaust the people who are willing to sell at 100,000? Do we see Bitcoin go up substantially above then to a new resting point? That's my base case. There's no guarantee it will happen, but I think the structural demand supply balance right now is pretty attractive. All right. I got to the end, Tony. We have some time for polls and questions, but I hope that was helpful.
Matt, that was amazing. And I just brought up on my phone, I took a screenshot of an article 3 days ago. It says Arizona State approves first ever US Bitcoin reserve set to invest 10% of 31 billion of state assets.
There you
So
go.
make sure you call them after we're done today. Nelson, let's see if hearts and minds were impacted today. Then we're going to open it up for questions. For all you veteran Zoom users, there's a chat button at the bottom of the screen. We'd prefer you enter in your questions there. Let's go ahead and do some clicking on the screen. I'm open to learning more and exploring. 50%. I feel more cautious than before. Interesting.
Yeah.
My view has 22. I'm seriously considering investing in cryptocurrency. All right. Matt, what does that tell you?
I think we did pretty well. I love it. I love it. I love that people were so engaged. I love people want to learn more. I'm excited about those people at the bottom, and I appreciate the people who still want to find out more. It's great.
Absolutely. Matt, let me tee up our first question and just help us with the dynamics of $37 trillion in debt and the debasement of currency. And I'll bring up Charlie Munger again. He said at one point, the dollar is likely to go to zero, just not in my lifetime. And he's gone now.
He is
But what impact is this? And then you got Ray Dalio talking about this major debt crisis coming up. But then there's countries that have higher debt to GDP ratios than we do. Can you talk to us a little bit about the national debt, the way we're adding to it, and the interplay with crypto?
Yeah, absolutely. I think it's a real concern that many people have, right? We have added these record numbers of debt, 37 trillion, as you said. Deficits are running at $2+ trillion a year, which is an incredible amount. And I think people are just significantly concerned that the dollar will follow the path of other fiat-backed currencies and lose value on an accelerating basis. Right now it's worth noting, Tony, that interest on the debt is our largest line item. We spend more servicing that debt than we do paying for defense, which is really scary. You get into this situation where there's no way out except for to inflate away the value of the currency. And I think people are increasingly concerned about that. It's not just Ray Dalio. I hear it every day from investors and financial advisors that they don't want 100% of their eggs in this one basket. We're printing dollars at a rate of about 14% per year, more dollars compounding on an ongoing basis. That doubles the supply of dollars in something like 6 or 7 years. It's not a good recipe. So I think more and more people want a hedge. Bitcoin for many people is the most efficient hedge. And I worry about that dollar debasement a lot.
Mm-hmm. Thanks for that, Matt. We were meeting with a really smart business owner that sold out his company for $1 gazillion. And he says, I won't touch Bitcoin because it's got no intrinsic value. And you alluded to that, but I remember at the Barron's conference, you talked a little bit about an NFT that went to auction and website URLs being digital assets as well. Can you riff on that a little bit?
That's completely right. I mean, I bought the URL ETF.com. I paid $500,000 for it. There was like a little bit of thing in my stomach when I sent a check over, and all I got was this digital asset. But it ended up being incredibly valuable. The reality is many of our most valuable things are digital in nature. You can't touch them. An example I use sometimes is if I lost this phone, would I be sad that I lost my iPhone, or would I be worried that I lost the pictures of my family? It's actually the digital things that are more valuable to us today than they were in the past. And even though it's hard to get your hands around initially, I I encourage people to look back at how they've thought about digital goods over the last 30 years. I remember being skeptical that I would want to read a newspaper in a digital format. I remember being skeptical that I would buy clothes online, right? You have to go touch it. But the trend in society is to get more and more comfortable and more confident with digital goods. And I think as we move into a digital age, it just seems likely that we'll have a digital version of gold. And it seems almost certain to me that Bitcoin will be it.
Mhm. I don't see any Nelson, do you see any
Right.
questions in the chat? Go ahead.
Yeah, no, there's a ton of great questions. And what I've tried to do here, Matt, is just kind of group a few of the similar questions.
Mhm.
And so the first one is just with regards to the supply of new Bitcoin that's mined. A couple of questions just around, can you maybe explain why there's only the 164, 250?
Yep.
And then what happens in future years when there are, no more Bitcoin to be mined.
Oh, yeah,
That
great,
encompasses a couple of them.
great
And
question.
Nelson, about the Bitcoin adoption curve, hit Matt with that one, because I've heard his answer on that.
Yeah, I'll do that one next.
Awesome. Yeah, let me hit the mining thing first. It's worth noting like why Bitcoin comes into the world, and then we can explain what happens, Nelson. If you think about what a bank does, it processes transactions and secures your wealth, and for that you pay it a fee. The Bitcoin network processes transaction and secures your wealth, but as I mentioned, there's no one to pay a fee to. So the way Bitcoin comes into the world is that the people who process these transactions are these 100,000+ computers all around the world, which we call miners. And every 10 minutes, they settle a block of Bitcoin transactions. And the miner that settles that block of transactions gets rewarded with new Bitcoin for doing so. That's how they're compensated. In the earliest days of Bitcoin, they got 50 Bitcoin every time they settled a block. And then it fell in half to 25, and then it fell in half to 12 and a half. And now it's about 3.125. And in another 3 years, it'll fall in half again. So Bitcoin has, started from zero, and through this process of miners settling transactions, we've gotten to 19.8 million Bitcoin, and we're on our way to 21 million. Now, you raised a good question about what happens when we get to 21 million. It's worth noting that's in the year 2140. So that's a very forward-thinking concern. But the way it works is the Bitcoin network can only process so many transactions at once. Let's say it's 10,000 transactions. But if 11,000 people want to send Bitcoin in any given 10-minute block, the Bitcoin miners have to choose which transactions to prioritize. And the way they do that is if you want to make sure your transaction goes through, you add a tip to it. Like if you process my transaction, I'll give you an extra dollar, I'll give you an extra $2. And the idea is that as this reward from new Bitcoin falls over time, this tip revenue will grow over time. And eventually the network will be self-sustaining 120 years from now. So that's the vision. And right now, that tip revenue is anywhere between 10 and 30% of the mining revenue that people get. So we're on the way towards making that transition.
Wonderful. A couple of other questions here. Whenever a new technology comes about, there's the technology adoption curve. Can you maybe just touch a little bit on, where you think we are in this adoption curve?
Yeah, absolutely. I think we're at the exponential phase of growth. I think we've crossed the chasm. If you think about early technologies, they're often early adopters who use that technology before it's fully baked, right? You have your friend who always has the latest iPhone or the latest car or the latest drone or the latest this, and they more or less work. I can remember cell phones when they were, like in a bag, and then when you had to push the letter 3 times to spell a letter, and there were people who did that, but they didn't really go mainstream until we got the iPhone, right? And it was super easy to use. And then you saw exponential growth because it came easy. I think Bitcoin is exactly at that space. I mentioned earlier that before ETFs launched, it was really hard to buy Bitcoin as an institutional investor. Now it's push button easy. It was really risky to buy it because other institutions hadn't done it and there was no regulatory certainty. And now those problems have been solved. So I think we're at the phase of accelerating adoption. And Yeah, every statistic I look at says that that seems to be, speeding up and not slowing down. And I think that's what we're seeing here as well.
Hey, Nelson, can you advance to the next slide? Some people may want to drop off. I want to hit as many questions as we can for as long as Matt can stick around, but just go to the next slide. We've got another webinar coming up. Don Luskin, who many of you have seen, is going to be on our calendar and hopefully yours on June 17th. There's a lot going on in the markets, and it's not just about tariffs, but we'll be talking about the markets, interest rates, inflation, the economy, everything having to do with how to invest your money wisely long term. So mark your calendars and be on the lookout. And Matt, I think you worked with Don Luskin a while ago, and I believe that he's on the webinar today. Haven't seen any questions from Don. But anyway, mark your calendars, June 17th. We're going to have fun again. So Nelson, back to the questions.
Wonderful. Next question is just with regards to, generally Bitcoin. I think we've done a fantastic job giving an overview, but how does Bitcoin compare to when people use the term cryptocurrency, or, a number of questions about Ethereum, and another popular Bitcoin. So can you maybe just describe maybe the difference between those two, and then the crypto industry as a whole?
Yeah, absolutely. After saying that, I did have the great pleasure of working for Don. He gave me my first job in finance. I learned a tremendous amount from him. He's one of my heroes, and I would definitely join this webinar. He's one of the sharpest minds in finance. So great to see his name up there. Yeah, I can briefly explain. It's a great question. There are all these different crypto assets, from Bitcoin to Ethereum to Solana, and all down. I like to explain it by talking about Bitcoin versus Ethereum. So every crypto asset is really two things. It's an asset and a blockchain. There's the Bitcoin asset and the Bitcoin blockchain, the Ethereum asset and the Ethereum blockchain. And blockchains are just pieces of software, so they can be designed to be good at different things. The same way Microsoft Word is good at word processing and Excel is good at crunching numbers, the Bitcoin blockchain is good at one thing, and the Ethereum blockchain is by purpose good at something else. So Bitcoin was the first blockchain. As a piece of software, it's really simple. All it can do is send Bitcoin, receive Bitcoin, hold Bitcoin, store Bitcoin. What it's exceptionally good at is it's the most secure software in the world, right? It's been running for 15 years. It's secured by the largest supercomputing network in the world. It rarely updates, so there's no chance there's a bug in it. And it's really good. That's great if you want to store wealth. All you care about is security. Ethereum looked at Bitcoin and said, it's amazing that you can securely hold wealth without a bank or a government. What if we could program that wealth to act like the New York Stock Exchange, or program it to act like an art house, or program it to act like a lending agent, or program it to act like a derivatives exchange? So Ethereum is like Bitcoin, but it can be programmed to move money in different ways. You may think, why is Bitcoin more valuable than Ethereum? Well, it turns out that storing wealth is a huge market, right? Gold is a $25 trillion market, so there's a lot of value in that. And Ethereum will never be as good as Bitcoin at storing wealth. But if you want to build a new version of how finance work, if you want to build payments in dollars, or you want to build trading in stocks or trading in derivatives, you can do that on Ethereum. And so there's this whole world of assets. And as you go down the list past Ethereum, you basically see blockchains that try to compete with Bitcoin, or blockchains that try to compete with Ethereum by differentiating in other ways. And there will forever be new attempts, just like there'll forever be new software startups. But these two assets have a big lead, right? Just like it's hard to disrupt Facebook, it's hard to disrupt Bitcoin. And I suspect that Bitcoin will be the winner for digital gold, and Ethereum, Solana, and some of the others will be winners in this more programmable space.
Nelson, let me hit up a question from our friend Jeff. It says, supply and I think you might have touched on this, Matt. I think you did. Supply and demand requires an upper and lower quantity limit. Could someone issue Bitcoin and flood the market, dropping values precipitously? Who's to say that this gang of people on all these computers don't just change the code and now it's not 21 million coins, let's double it to 42 million. More supply, the price goes down.
Yeah, this is the incredible thing about Bitcoin. So it's hard coded into the software. It could be overridden if half of all the people who care about Bitcoin and maintain the network decided to change the number. But that's not going to happen, because if you change the number, you would destroy the value of Bitcoin. And these people who maintain the network really care about the value of Bitcoin. So it has, what I would call a game theoretic guarantee that there won't ever be a changed number, because it would destroy the very thing they're trying to protect. So I think you can feel extraordinarily confident that it'll only be 21 million, because there's not one person in charge who would benefit from it. It's the collective we that cares about Bitcoin.
Terrific. Nelson, you want to harvest one more? Then we ought to respect
Yeah.
people's time. Go and just
I think
offer.
I got, one more that encompasses a number of these questions. And that's just with regard to, how do you own this asset? And I think you touched on it a little bit, throughout the presentation. But, there's wallets where you can actually own, a coin directly. But now there are so many other ways to do it. So can you just talk a little bit about the different ways you can own it, and maybe compare, owning it in an ETF versus, owning a coin directly?
Yeah, absolutely. In the end, when you own a Bitcoin, as an example, what you own is a password that lets you move it. And you can own it in different ways. You can own it yourself in your own wallet. If you can write down that password and not lose it, not have it hacked or stolen, not have someone get off with it. It's similar to owning your own gold bars and tucking them under your bed. And plenty of people do that. You can own it through an exchange like Coinbase, although there's certain risks that are involved with keeping a password stored in an online format that many people don't want to do that at scale. The beauty of ETFs is they follow the best institutional custody approach in the world. They use qualified custodians with insurance in place who have a decade plus of experience of correctly custodying and holding their Bitcoin. And they've been doing it for billions of dollars over long periods of time. I really do think it's the most efficient, low cost, and secure way to hold your Bitcoin. My favorite fact about this, Nelson, is, the Abu Dhabi Sovereign Wealth Fund, one of the largest investors in the world, chose an ETF as their way of owning Bitcoin. And my father uses ETFs to own Bitcoin. That's the beauty of this. The largest institutions in the world and any retail investor can use the same tool at the same terms, at the same low cost, to gain secure exposure to Bitcoin. So I think, if you're a tech genius, if you're in cybersecurity, I think owning Bitcoin directly is wonderful. But for many of us, certainly for my own assets, the ETFs allow us to rely on the largest institutional custodians in the world to do it properly. And I think that gives a lot of peace of mind.
Matt, I'm going with the ETF because I do not want another password to forget, because the stakes with this one are pretty high. And then how do you own it? I'll just circle back to what I said before. Have a plan. Make sure you've got a solid balance sheet. You've projected cash flows into the future. You've stress tested that plan. You've lowered current taxes, lifetime taxes. You've got a bulletproof estate plan. You've got the basics: stocks, bonds, cash, real estate, and then you decide how much crypto to add to your portfolio. At least that's the official position at Parr McKnight. Matt, I want to thank you for your time today. Very illuminating. Special shout out to Nelson for putting the tech in place to get this campaign done. Also, my neighbor here in the office, Melissa, that pestered all of you to join us today. So thanks. Join us on June 17th with Don Luskin. And Matt, we'll talk to you again real soon. Thank you again.
Thank
Have
you
a great
for
day,
having me.
everybody.
Really appreciate it.
Thanks, Matt.